So, you want to get into trading, right? You've seen the screenshots online, the Lamborghini rentals, the luxury vacations, the people claiming they turned a few $100s into millions overnight. It's an incredibly alluring world. The promise of financial freedom, of being your own boss, of watching your money work for you while you sleep. It's the modern-day gold rush. But here's the thing that nobody in those flashy ads wants to talk about. For every one person who supposedly makes it big, there are hundreds, if not thousands, who lose everything. And it's not because they're not smart, it's because they've been sold a complete fantasy. The entire trading education industry is built on myths to get you to spend your money, not make it. They sell easy profits, secret formulas, courses, and signal groups. The reality is that trading is a serious business that requires skill, discipline, and a healthy dose of realism. It's not a lottery ticket. Treating it like one drains your bank account. That's why we're making this video, to expose the 10 biggest myths costing new traders a fortune and replace them with practical truth. Let's smash the first myth. You don't need to be rich to start. Thanks to modern brokerages, fractional shares and micro contracts exist. You can start with as little as $100, but hear me, that does not mean get rich quick. Starting small? Priority one isn't making money. It's not losing money. Treat early capital as tuition. On $500, risk 1% to and 2% per trade. 1% is $5. That's your max loss. A $100 risk blows you up in 5 losses. $5 risk takes 100 consecutive losses to bust. Forget needing a huge pile of cash. Use small, prepared to lose capital, risk a tiny fraction per trade, and focus on skill building. Trading is not a magical ATM. It's slow, methodical, and often boring. A get-rich-slowly-if-you-don't-mess-up business. Winning streaks happen. So do brutal losing streaks. Your equity won't go straight up. Success comes from positive expectancy over hundreds of trades. Indicatoritis, RSI, MACD, stochastic, Bollinger Bands, Ichimoku, moving averages. It's a candy store. More is not better. Plastering charts breeds analysis paralysis and conflicting signals. Indicators are derivatives of price or volume. They lag. The most important indicator is price itself. Clean chart marks support and resistance. If price forms a bullish pattern at support, the buy is simple and clear. Use 2-3 indicators that complement price, e.g., 1 MA for trend, 1 oscillator like RSI for exhaustion. Keep it clean. Catching exact tops and bottoms is a fantasy. An ego exercise in a complex system no one can time perfectly. Top picking leads you to fight strong trends, add to losers, and meet margin calls. Ask: is this area likely to hold as support? Can I define my risk? Wait for bottoming. First high or low, buy the pullback, stop under the low. Maybe you missed the bottom. You gained confirmation and a safety net. Focus on trend, high probability entries, strict stops. Capture the middle 80%, not the first and last 1%. Let go of the ego need to be perfectly right. Trade your process, clean charts, price first, limited tools. Probabilities, confirmations, stops. We love being right, but win rate alone is meaningless. You can win 90% and still lose money. Profitability, sheer positive expectancy, win rate plus risk to reward. Trader, A, 90% win rate, plum dollar winners, $10 losers, 9 wins, chop a 9, 1 loss, chalker $10, net, $1 after 10 trades. Trader B, 40% wins, risk $10 to make $30, 4 wins, chakra $120, 6 losses, chalker $60, net for $60. Chasing win rate makes you take profits too early and hold losers too long. It's not how often you win, it's how much when right versus how much when wrong. Let winners run, cut losers short. Backtests sell robots with perfect equity curves. Most are overfitted, curve fitted to old data. A key that fit from 2010 to 2018 often fails now. In live markets, volatility changes, patterns vanish, equity nosedives. Do in-sample versus out-of-sample testing, then forward test on demo. The only test that truly matters. Even then, no guarantees. Markets evolve. Keep risk management as your primary safety net. Chase expectancy, not win rate. Validate beyond backtests. Always wear your seatbelt. Risk controls. The screen-glued click-crazy trader is a myth. Overtrading kills profitability and mental capital. When you feel you must trade, you lower standards and take low-probability setups. Every trade has costs, commissions, spread, and your psychology. Quality over quantity. Wait for A-plus setups. If it's not there, do nothing. A professional skill. Some days are choppy or too volatile. The best trade is no trade. Protect ammo, your capital. 2 or 3 thoughtful trades a week beat 20 impulsive ones. Build a plan. Wait for it. Execute. Your P&L will thank you. Patience, non-profitability. Systems are essential, but they don't erase fear, greed, hope, regret, especially with real money. Your plan is the anchor you wrote calm. Follow it when you're not calm. The battle is discipline, non-negotiable rules. Stop loss is sacred. Decide it before entry and never move it wider. Keep a detailed journal. Include how you felt. Right-size positions. If you can't sleep, it's too big. A good system is the map. Discipline is the fuel. Lower size to lower emotion. Execute cleanly. Leverage is misunderstood and abused. Ads shout 100.1, control 100K with 1K. Sounds like a cheat code, but leverage is a double-edged sword. It magnifies profits and losses. Most new traders lose. Leverage accelerates wipeouts. $1,000, no leverage. 10% drop. $100, you still have $900. 20.1 leverage. Same drop. $2,000, you're wiped and may owe. A 10% move becomes a 200% loss. Pros use low or no leverage, and always with hard stops. Think of leverage as hazardous. If at all, use extreme care. Huge followings, profit screenshots, fancy cars, signal groups. The temptation is real. You can't verify results. Screenshots can be demo or edited, winners shown, losses hidden. Even if they're profitable, their risk, drawdowns, lifestyle, and speed may not fit you. Copying alerts without the why is like performing surgery from a video. When it goes red, you panic, no framework to decide. Signals make you dependent. You bought a fish. You igwalsenditer, tidendarikan en sinden, diverger igerbury, iranarisen, either learn to fish. Become an independent thinker, learn from books and videos, test concepts yourself, adapt to your personality and risk tolerance, build your own strategy. Your financial future is too important to outsource to a stranger. Invest in your education, not in someone else's signals. So, there you have it, the 10 most destructive myths that lure aspiring traders into financial pain. From thinking you need a fortune to start, to believing a guru has all the answers, these misconceptions cause most failures. They promise an easy way out, a shortcut to wealth that doesn't exist. The real path is slow, deliberate, education, discipline, and rigorous risk management. Start small and protect capital. Accept it's a get-rich-slow journey. Keep charts clean. Think in probabilities. Prioritize risk to reward over win rate. Be skeptical of backtests. Be patient. Master your emotions. Respect leverage. Think independently. Trading is one of the most challenging endeavors, and one of the most rewarding with the right mindset. It will test your discipline and resilience like nothing else. Our goal today was to save you money by arming you with the truth. Don't fall for the hype. Build skills brick by brick. Manage risk obsessively, and treat trading like the serious business it is. Do that, and you give yourself a genuine fighting chance. Thanks so much for watching. If you got value, smash the like button. Subscribe for more no-nonsense trading content.